All right. Well, welcome everyone to this month's investment webinar. This is your host, Certified Master Coach John Randall. With us, as always, we have D2 investment guru and top advisor Drew Watson. Today, I have a very special guest, a guest speaker today. Beth Deal from Hickory, North Carolina is on. She's going to show us how she goes through some cases and identifies some tax opportunities for clients. And we'll show how she creates great value and also how she goes through an actual tax return to find new business from your clients. So, Drew, boy, it's certainly been a roller coaster here the first 2.5 months. Like that first big hill, we go down quick, and then we come right back up to where we were. So what's the latest in the investment world? What's the latest with the economy these days?
Well, you know, John, they're talking about the U.S. economy. The newest measurement used is how big are my hands. That's how big the U.S. economy is. If we look at reports that IRG is putting out, towards the end of February, they had a fantastic report, economic update, where they basically they said to summarize that they don't think that we are going into a recession, but they felt like the economy was kind of just muddling along at, what I would say very kind of reasonable but lower growth. But the big thing is they thought the odds of a recession this year were pretty slim, and couple that with, February 10th, February 11th appears to be pretty good lows in the market, especially in the energy market. We had lots of reports. We had kind of 3 events happen almost simultaneously. One being we had a release of Chinese oil usage data. It was clear that year over year their oil consumption was up. That's a positive. That kind of put maybe a little bit of an underpinning in the market. And I think you got continued reports that the impending doom of the Iranians dumping millions of barrels of crude on the market every day, I think have been kind of washed away. One, there's a strong suspicion that probably the Iraqi production has a couple 100,000 barrels a day, perhaps, of Iranian production with it. It's hard to keep your production where it was when you lose half of your oil fields to ISIS. And secondarily, the initial inspection by the 5 big multinational oil companies, Shell, BP, Total, Exxon, and Chevron, have indicated that there's about a $300 billion plus capital expenditure budget needed just to bring kind of Iran into the new century of oil production, as it were. And it can be very difficult to entice a shareholder base to make that kind of investment in a country where you could literally, John, probably lose your ear for having a pocket square in like that today.
That's right.
To put that in perspective, the high year for CapEx spending from the entire S&P energy complex, so not just oil, but the entire complex, was the 13-14 budget year when you had probably $120 oil, John, and that was $90 billion. So Iran is going to need somewhere north of 3.5 times that amount of money, and it's hard to see where that cash is going to come from. So that being said, it does appear that now the world energy community is in the consensus that we don't have a demand problem. It's really a supply problem, and a supply problem, I think, is much easier to correct than a demand problem. So that's one piece of news that came in February. And then the final one is you also had around mid-February Magellan Midstream, which is an energy gas pipeline company, needed to price about $650 million worth of 10-year debt. They came in at about 5%. It was oversubscribed. So that put the energy complex here in the U.S. at a little bit more of a firm footing than what it had been on for a couple of months. And then we've seen stocks respond positively. I think the Fed meeting showed that the Federal Reserve is going to continue to be accommodative. The European Central Bank meeting showed that they are going to continue to be accommodative. So right now, that's mainly tailwinds that are back. The economic piece that IRG put out towards the end of February, 1st of March, also indicated that their suspicion was a strong U.S. dollar is really what has created the havoc and the volatility in the markets. And our theme has been, let's move more of our dollars to investments that have most of their income coming in from the United States, and we don't have to worry about a strong dollar headwinds, and that's paid off pretty handsomely for us really since the beginning of the year. But with that said, it's important to kind of evaluate where we are, because the dollar did pick up strength yesterday in the wake of yet another terrorist attack. These things are becoming commonplace. Just before we went on the air, ISIS released a report. They have sent 400, or they're claiming to have sent 400 terrorists into Europe out of Syria. And so, you could take that number of people for what it's worth, basically giving them discretion on where and when to attack. So that's something that may be an investment opportunity, because it appears Europe, especially some countries there in Western Europe, have been loath to invest in the type of security infrastructure that's needed to help protect its citizenry. So that will probably put a little bit more volatility in the markets, John, and I think we need to kind of, be prepared for that. Areas that have done, well in this kind of new quote-unquote risk-on trade, energy had a really nice rebound. We did some work for a larger client of ours earlier today, and out of the big integrated, I think every one of them, with the exception, Chevron and Exxon are both above all their moving averages. Royal Dutch Shell was above all but the 200-day. The one stock that hasn't really been kind of going along with the group, John, has been BP. But also, on days when the market's good, you see pretty good growth from the risk-on names. Days like today, utilities and consumer staples have done stronger. If you follow the investment portfolios that both IRG and S&P put out, like we do, you notice more and more of their additions are in that same theme that we're following. Lower U.S. dollar exposure, but stable cash flow, a lot of consumer staples, some quasi-utilities to provide kind of that backbone of where we are. And let's talk interest rates a little bit. 10-year, I think on our last call, was probably, it was a lot lower than what it is now. February was a great month to lock in a rate to refinance a mortgage. Looks like today we're going out somewhere around 1.95 on the 10-year. That's, not too bad. We've had a little rally because of the terrorist attack. Dollar gained some strength today, a little bit. Euro's down to 111. I think yesterday morning it hit 109. The pound, it's down to about 141. And let's talk about Britain, John. One of the things that we're looking at on our calendar is June 23rd, I think, is the day that the British vote whether or not to exit the European Union. Beginning in 1951, Europe has had some type of coalition economically on the continent. In 51, it was the Steel and Coal Union. That was France, Netherlands, Luxembourg, Belgium, and West Germany and Italy. And basically, the European Union is kind of the newest evolution of that. And so the British people are going to vote whether or not to stay in that union. This is the second big vote in the British Isles in as many years. Last year, the Scots voted to remain in the union and not secede. It was, quote-unquote, a neck-and-neck polling race up to the election. And I think the votes to stay in I think they won that by 8 or 9 points. It's a close vote, and of course, anytime you get a terrorist action like what we've gotten in the last, few days here, that puts pressure, and it's a little bit brings to bear maybe people wanting to leave the Eurozone. The big things on the agenda, John, are trade, kind of free trade within Europe, and then also free kind of open borders type policy. So I'm sure we'll get every bit of 2 or 3 months worth of that discussion on the news. And also, our presidential election, John, is going to be front and center. If we look at sectors that have been under a lot of pressure, healthcare has been under a lot of pressure. It looks like Hillary is a front runner in this general election, and she has named names and put her target on the backs of some very high-profile biotech and pharmaceutical companies, and she wants things changed. The best-performing for-profit hospital stock that we follow out of a group of about 5 or 6 is down about 20-25%, and that's the best of the likes. And, they're blaming Obamacare. The other thing I think that's struggling with the healthcare is, Trump has not really distanced himself from a single-payer system. He has made some comments. He owns businesses in countries where they have a single-payer system. And he's not necessarily ruled that out, and that's going to hurt him. I do think if we get to this Republican convention, John, and there's a bunch of shenanigans that goes on, that will probably cause some market turmoil. Therefore, I would look at your fixed income piece to be kind of the rock of Gibraltar, as it were, in this volatility. And what you want there is good credit, stable credit. That is the ability to probably weather the storm as best as you can with regards to that. And then see which candidate comes out of it and what the election looks like. If the Republicans splinter, I'd say effectively what you're going to do is give that election to Hillary. I personally think, John, the thing to look at in that case, who will be the big beneficiaries? I think big banks. You've got Hillary, it's been widely noted, has taken more money from Wall Street than any candidate left standing, and I would say she would be expected to kind of help them out. I don't think you'd see kind of an outright repeal of the Dodd-Frank bill, but you would probably see some of the more stringent pieces of it rolled back, maybe in a Hillary administration. And then, of course, we would have the first gentleman, William Jefferson Clinton. He's one of our all-time favorites here in Kentucky, as he is a good old boy, as they say. So we wait for bated breath about that. I would say, another thing to be talking to your clients about, eventually a recession will happen. I mean, it's a fact of life. It's like getting a zit. Eventually it just shows up no matter how much, Neutrogena you put on yourself every day. Hopefully it'll be a short recession and it'll be very mild, but basically, at some point it'll be coming, and Ameriprise thinking, and Fidelity's in the same boat. I mean, I think it's a little bit ways off, but I think it's always good to prepare your client for that eventuality so they can be prepared themselves. But yeah, that's kind of what we've been discussing with our clients. U.S. dollar strength, how to protect yourself from that, get ready for a recession at some point, and let's talk about who the winners and losers might be in the election. Eventually that's coming. And what would a Great Britain exit mean to the Eurozone? That probably wouldn't be good, and it just depends on how orderly or disorderly it is. I can tell you by looking at the currency, it really weakens the British pound, which would be great if you're vacationing there, and also eventually pretty good for British exports. So, John, if you drive a Jaguar or a Land Rover, you might be in pretty good way to be able to get a good deal here in the U.S.
Nice. So, great overall update. Great insights. What you're saying to clients. So you talked about just protecting using high-quality fixed income. What other strategic moves would you say you've made in the last a few months since we kicked off the year with our kind of initial investment spreadsheet update?
We're lighting up our position in United Kingdom. We got out of Glaxo this week. We're buying more U.S. kind of mainly businesses. That's worked out pretty well. We haven't been scared to take profits. And in the energy patch, we consolidate into your better credit quality people. The cost of capital is key. And surprisingly enough, Chevron's cost of capital on their 10-year debt is a little bit below Exxon's. So those two, I think, are good long-term investments depending on the entry point where you got in. They're now, depending on where you read, oil prices maybe $50 or $60 by the end of the year. I mean, they could be $30. Who knows? But that's some of the changes that we've made. We had a really constructive report on BXMT, which is kind of the real estate workhorse we've been using. Their credit is pretty extraordinary in there. It'll have some volatility, but it's been kind of a workhorse of ours. I think, John, my kind of prediction would be if you've got anybody on the call that are big owners of agricultural stocks, especially like John Deere, and businesses that have a lot of exposure on equipment leases, those might be things to look at because, Hillary is talking about maybe, the rich people get all the tax breaks. The big tax break hanging out there is that $500,000 Section 179 depreciation loophole for businesses. If that thing gets squeezed, you could be looking at some trouble in machinery land. Anything with that, like Caterpillar, Deere, we've really kind of cleared out from that standpoint. It also appears kind of thematically, John, a lot of retailers, no matter if you're selling automobiles, women's blouses, shoes, lawnmowers, and I'm talking about the brick and mortar businesses now, have had extraordinary starts to the year. It appears, your longer term trend is people are really shopping with their fingertips for Christmas. They get through Christmas, they want to actually walk on the floor somewhere and eyeball what the big after Christmas sales have to offer. That's proven to be probably this year bigger than last year. For people using the moderate dividend growth portfolio, they've seen Target really take off. Cracker Barrel, it's gone up like everybody in the country is eating biscuits and gravy and chicken and dumplings every day, which would mean we need to be buying casket companies because heart attacks are going to be following in short order. That's kind of what we've been doing. S&P added a company like Church & Dwight to their growth portfolio. It's a consumer staples company. Arm & Hammer baking soda, Trojan prophylactics, Absorbing Junior, those types of products. They did away with WD-40, which is one of my personal favorites. And they're really hammering home that kind of consumer staples growth idea. And I'd say probably in closing, what really blew it out last year, so if you had mutual funds that really kicked butt last year, chances are they had probably Facebook, Amazon, Netflix, or Google in there. Amazon has struggled to start the year. Facebook, I think, is up to about 112 right now. So, keep in mind kind of a little bit of a return to value has helped some of the more dividend-paying stable companies this year compared to some of the high flyers of 2015.
Very nice. Awesome updates as always. So if you have more questions for Drew, go ahead and post on the box. We can pick those up as we go, or feel free to send me or Drew an email. We'd be happy to address those for you. So at this point, let's switch gears. Jacqueline, if you could switch things over and bring up Best Things. As I said before, we have Beth Deal out of Hickory, North Carolina. And we've actually had a lot of advisors reach out to Beth and trying to get the information she's going to share with us today. So she's certainly an expert in reading the tax return and finding client opportunities, which we can all benefit from. So Beth, welcome to the call, and thank you for being on today.
You're welcome. Thank you very much.
So we're going to share the screen here in a minute, and we got all your slides up. And before we get into this, just give us kind of a high level of some of the things we're going to dive into, some of the tax benefits and some of the things that you found have worked in digging into a client's tax return.
Well, and I think I've actually ended up doing it twice today as far as what I'm going to share with all of you. But I've firmly believed that if I can help a client understand their tax return and maybe save 10% in a bracket, I don't have to work as hard as Drew, what you're sharing to be able to make sure that we're in the right places. And so I think it's one more way of adding value for the client, but it's also giving us the ability to have conversations that aren't just about their investment portfolios. And I think that becomes even better. What I'm going to do today is walk you pretty quickly through ways to speak to the client, some of it education, some of it that I go over with them all the time. And then I want to give you a specific case of a way to actually use it. There's many, many ways that you can take this information and apply it based upon your client's goals. But I'll share you one way with some life insurance and the 9 circles as well. You want me to just go ahead and start?
Yeah, let's go for it. We'll rip through the slides here and kind of advance as
all right, as we go.
Yeah.
What we're seeing now is what I call the 4 cornerstones, which I've used as long as I've practiced. I've practiced 24 years, but I decided to put it in the form of a financial house, and that's how I talk to clients. They get it, they understand, and what we do in a given year time period is we walk through the house, and we do some renovations. We talk about things that may need some maintenance, things that need to be adjusted. And I put the foundation on the bottom because it's so critical for them, as all of us know, the cash reserves, the protection portfolio. And upstairs, we talk about the investment portfolio and the taxes and legacy. And today we'll talk about taxes. How can that be part of what you've got to do? And in this case, if you don't take advantage of it, the roof might fall in or it might blow off. So, but I wanted to show you, this is what I start out pretty much all my conversations. It stays on the screen. It's just something that the clients get really used to when they talk to me. We talk about what room we're going after. One final thing on this, I found it very beneficial. Words are instruments of power, and the way that you use your words are very important and critical. And we talk about their investment portfolios all the time, so I found it really important to talk about their protection portfolio. That's why you'll see that on there. That's how clients think. So their portfolio of that may include life insurance, disability, long-term care, or health insurance. But I've found that to be important. And then finally, that word legacy underneath taxes has become a real important word because it may mean lots of different things to the clients. The next slide, John, I got from Craig Brimhall, did a whole series on Roth Conversions. And Roth Conversions is something you can utilize as a strategy with what I'm going to talk to you about as well. But this chart's in here for Lynn Davidson, who I hope's on the call. But this, I use it all the time. It's extraordinary because what we're telling clients is, where are you on this stair step? And we want to fill it up. Because if we can fill up, for example, the 15% tax bracket, look at that huge increase you're going to take up to the 25. But if you leave it, then you may be not taking advantage of opportunity. I used it today, for example, with she was an attorney who's retired, but I have conversations with husband and wife when they're both living that, depending upon today, you may be in a 15% tax bracket because you're married filing joint. if something were to happen to one of you, or when something happens to one of you, and you're a single taxpayer, you may, with the same amount of taxable income, now be in a 25% bracket. Do you want to pay that extra 10% in a time where you may not really have as much confidence that you'll be able to sustain? So this chart is of great value. Clients don't realize that they may be in different areas of their bracket. The next slide, then, I want to give you an illustration of a way to sort of explain to clients where they are with their money. And if we would agree, we have a potential tax break, or we may pay tax in 4 different areas. When we put money into an investment, when the money grows, when the money goes out, and if we transfer it by gifting or death. That's pretty much how it works, okay? So the next slide then allows us to take this, and I know all of you remember the tax control triangle. And this is actually a reincarnation of the tax control triangle by Tim McClurg, who is my insurance RVP, John, yours, and many on the call. But Tim said that we really needed to do it in circles. And actually, this works best if, for the client, you draw the circle to the size of what fills up these different circles. You know, if they've got a whole lot of retirement plan money, make that circle as big as you can get it on the page, because that helps. But let me walk through this very quickly. So tax now money, if we would agree, is the money, and I call it outside of the retirement wrapper. And clients get that because that helps them understand that's pretty much everything else. It may be their house, a stock portfolio. It could be anything that they're going to pay tax on. So when they put the money in, it already is taxed, right? When the money grows, they're going to be taxed. So that's the second X. When money goes out, are they taxed? Yes. So it's actually taxed 3 times. Now, when we transfer it by gifting or by death, we may get a step up in value. If it's an S Corp valuation, there may be a discount that happens. So out of the 4 ways of taxation, they may not be taxed. The second one is non-qualified annuities, and you'll see that as a hybrid because when you put the money in, it's after-tax dollars. When the money grows, though, you do not pay tax on it at that time. It's deferred. When the money goes out, you pay tax on a provisional amount of it. The earnings have to be taxed first, but you never pay tax on the principal. When it transfers by gifting or death, for the most part, it is taxable. Then we have the tax later, and this is where the majority, I think, of our clients hold their money. When you put the money in, it's not taxed. You get a deduction. When the money grows, it's not taxed. But when the money goes out, it is, and if you transfer by gifting or by death, it's typically taxed. You could stretch it out a little bit, but it's usually taxed. And then our last bucket is tax-free. This could be your Roth IRA. It's cash value of life insurance, but it's also life insurance death benefits, and for the most part, most muni bonds. So when you put the money in, it's taxed. When the money grows, you're not taxed. When the money goes out, you're usually not taxed. Munis, you may have some gain in it. And when you transfer by gifting or death, there's no tax. So this helps the client understand better where they may want to position or where we may want to be moving money over a period of time. So just a new concept of the tax control triangle. So hopefully that's helpful. The next slide is a really important tool that you need in your toolkit. So there's a couple places you can get this. This is from RiverSource Insurance. We have advanced directors, which are attorneys that sit on our internal desk that have put this together. So you can just, and John, I forgot to ask you if we were going to be able to provide this, but you can get your internals to send you these. I actually have quite a few. Putnam also, if you do business with them, has a really great laminated one that they can send you. But I have it on my desk all the time. Clients take them, so I have to have several. But I use it over and over. And I think we said, thank you. John's got the Putnam one. Excellent. I love it. And I don't know if we can zoom in on this. I think we talked about that a little bit. But the key here is you bring this up to the client, you show it to them, and you show them their income tax bracket and where they fall. So going back, if the first, I'm going under married filing joint, the first 0 to $18,550, and remember this is taxable income after they've taken all their deductions and exemptions, they're taxed at 10%. The next marginal bracket goes up to $75,300. That's taxed at 15. And again, a single taxpayer is taxed at 15, only up to $37,650. So really important places. And then we have all the other brackets. Clients need to understand the next dollar that they earn from whatever it comes from, what rate are they going to be taxed at? That's very important to them and for you as you try to determine. This little chart also gives us the 3.8 net investment income tax, which is an important thing to talk to clients about. And it also gives us our long-term capital gains and qualified dividend rates. Again, we've had these now for a number of years. That could change, as Drew talked about with the political scene. But get you this, make sure you have it on your desk, talk to your clients all the time. This is important to be able to give them perspective and to see about filling up that bracket. So, for example, if I've got a client that has married filing joint taxable income of $50,000, that gives me $25,300 more that we might want to show on that tax return at a 15% bracket. Especially thinking if they're married filing joint and, maybe they're in later years, and if they don't take that out now, that same $20,000 to the client as a single individual may be taxed at 25%. Okay? So that's a huge planning opportunity. The next slide that I'd like to share with you is a spreadsheet that I've used for a number of years. It's just a real simple Excel spreadsheet. This is all this is. It doesn't even do calculations, but it's important. A lot of your CPAs, when they give you your client's tax return, do comparisons, but you got to show the client comparisons. And we use it. You'll see estimated 2016. I use it to do some estimates. Remember, we are not tax preparers. You always give those disclaimers. I think you see that down at the bottom. But it's important for you to take advantage of this. And I have a rule, and I say this to all my clients. If you have income that shows up on your tax return, you must spend it. And they look at me like, what? You're crazy. I said, no. Number one, if you're reinvesting your dividends, you're already spending it. You had to pay tax on it. You might use it for cash flow. You might choose to gift it. Or if you don't do anything, you're going to pay the IRS. That's how you're spending it. It is gone from you. You have to make that choice. Would you like to look at some opportunities that may allow you to keep more of it? And they'll say yes. Another part that's really important, if you don't understand it, this could be a whole other session, but you need to understand taxation of Social Security. There's a form that goes over that. Four Field's got a really great article on it, but you need to understand that because clients don't realize they're paying tax on their Social Security. They need to understand it. For most of our clients, their cash flows that we develop for them and what they have always cause them about 85% of their Social Security to be taxed, but that's an important consideration on here. Okay, so again, this is just one of my tools. I encourage you, develop something that you're showing clients the differences in their taxes, in their tax returns, and they can do it. And so we use this to show what if we fill up a bracket, what's going to happen to help them understand it. The next slide, I love this thing. And this is awesome. It's called Taxes and Portfolio May Be Larger Than the Appearance. It's called the iceberg. You can call your insurance internals. They have this. Somebody up there found it. But I have started showing this to clients and leaving it up on the screen, and they just love it. And it's so true because we don't really remember that there are lots of things that could happen, and let's take advantage. The next slide is sort of a segue now into how do I use this in cases. I've started using Confident Retirement for all of my top tier clients. All of my high net worth love it. And I know it seems to be really simple. I still have Navaplan as my backup working papers, but Confident Retirement interactively with them is amazing. And what we're doing, when you talk to them about tax planning, they've got to believe that their cash flow is still okay. They got to believe they're okay. Then you say, let me show you a better way. And so the next slide I want to show you is really the case. One of your best tools that you have is Brentmark. So I assume all of, hopefully you know how to do it. If you don't, again, I tend to be using insurance in this particular case, but your internals, my internal, actually, Larry Bell, runs all of these for me. We meet twice a month on a phone call. He works up all my cases for my insurance, and he runs these for me. So he prints them out even and sends them to me. So
and hey, Beth, just a quick insight. This tool is on Compass now. If you go to tools and list of all tools, it's in there. It used to be a program on our Ameriprise computers, but it's all online now. You can find it on Compass.
Yeah, it's awesome. And you can also do beneficial IRA stretch calculations for this. There's just lots of uses for this. But this is the particular case. This actually is in the process right now. But what I've been doing with the majority of my clients, especially if they're now in retirement, is saying, you know what? It may not be a bad idea to begin taking some of your distributions from your IRA, even if they don't need it for cash flow, before 70 and a half. And they're like, really? And I said, yes, and that's filling up that bracket. Because if something happens to one of my clients and all of a sudden the spouse is paying 25% instead of 15%, I really did a disservice in helping them wait. And so I started thinking about that, and I'm like, man, and then what are we going to do with it? What if we could take this money, going back to the tax control circles, and reposition it so that it could be utilized and actually get more leverage. And leverage is another one of those really important words that clients understand. We're taking a discounted dollar and we're being able to leverage it up into something that is bigger. And that's very beneficial in today's world where, I might have had to have had a conversation on their investment portfolio that it was down, but now let's look at what we've done, and you actually still have this whole amount of money. You don't have to worry about your legacy. The next slide on this is the first part of this report. And John, what I'm going to do, this is basically showing these clients, they've got $1,054,000 in their IRA. You can use whatever expected plan growth you want, and I'm saying both of them are going to live to their life expectancies. And so this is showing that they aren't going to start taking income until they turn 70. Okay? And the second page of this, if we can go to that, I always go and show them age 90. And at age 90, in this case would be like 2039, they're going to have about $1,040,000 in their IRA, and they're almost at $91,000 of a distribution based upon the factor. So if we would all agree, their tax bracket continually went up without their control, because this was just based upon the MBID factors that the IRS requires us to do. Okay, so this is if nothing happens. The next slide is you do have to do some mathematical stuff where we look at their tax brackets, how much room do I have. Again, most of my clients are already paying 85% on their Social Security, so I don't have to worry so much about that. But then we can also even look at weighted averages and say, what if we took this amount out? Could we even out how much is coming out every year so that their tax experience continues to be the same, which is really cool. How many times have you had clients say, man, I owed so much money and you should have done something for me and I don't understand this. This helps take advantage of evening it out. So the next slide shows that if we began at age 67 And again, in this particular case, Larry and I worked on it, and we got to $60,000. And what we determined was for their cash flow with Confident Retirement, they needed some of that. They were going to need some of this for their income stream, but they had a lot of it left that they didn't need to utilize pretty much for their lifetime. But if we spread it out, and John, if you would, let's go to, again, 2039 at age 90, it's a considerable amount less that they're going to have in their IRA. They actually took out almost the same distributions. But what we chose to do with a portion of this, again, they're using some of it, but remember, if we had done nothing, they would have been taking out almost $91,000 at that same time. So a huge amount of tax savings that has happened throughout this time period. I've given you an illustration of one of the things you could do with this, and this is what we're doing with this client. The next slide shows what's called a survivorship multi-index universal life. It's a second to die policy. And so the next slide, John, basically just shows, we just ran an illustration with $28,000. That's a net amount. Remember, you're taking out $60,000, you're going to pay some tax on it, and at whatever marginal rate that worked out for them. In their case, remember I had $75,000 in the 15% married filing joint bracket, and with this and their Social Security, we're right at it. It's just beautiful. It's working out great. We did a 15-pay. It leveraged up to $700,000, and in this illustration, I know it's hard to see there, but it actually, on these multi-index policies, there's something called corridor. Again, this is another thing you can spend probably 30 minutes to an hour with your insurance RVP, and they'll explain it to you. But corridor just means that you've hit where the IRS says you got to start bumping up that death benefit because of the cash value you have. It's a great benefit to the client, something that you want to craft these for that. John, we can skip through a couple of these slides to the next one. It's called internal rate of return. I just wanted to show all the advisors that it's important. One of the slides one of the reports you always want to do when you sell insurance is the internal rate of return. It's critical. Remember, you're removing monies from an investment portfolio that you've done an incredible job trying to earn them as much as you can, and you're moving it to something different, whether it be a Roth conversion or life insurance. You need to explain to them that, frankly, we're not really changing a whole lot of the overall return. So your internal rate of return report can show that on your cash surrender as well as your death benefit. Very important slide to be able to use. And then we can flip through cost of insurance. Again, I just added that. That's something you can do. Let's go then to 9 circles. This is a wonderful calculator if you're not familiar with it. Again, it's something you can do on Compass, or you can have your internal help you with. It's one of the simplest things we've ever put together that works great. I think, John, you've used this before as well for a really great case. You go on Compass under search and just type in 9 circles, and the calculator pops up. What I'm going to show you is how I utilize those Brent Mark illustrations to show the client. So up here, you end up putting in your age 90 IRA value if you do nothing. So in their case, it was $1,040,353. We also put in their age 90 amount if we did go ahead and start evening out those distributions. Remember, at $60,000 a year, at age 90, they'd have $627,266. And then the life insurance death benefit that we ran the illustration at age 90 is going to be about $1.2 million. The assumed tax rate on 9 circles needs to be your beneficiary's tax rate. Okay, so it's normally your children's tax rate. So we use 30, and the state that these clients' kids live is 7.5%. Okay, and what happens is it comes down, and it's a cool program. It shows you with their current strategy, the do-nothing strategy, their kids would at their age 90, if they both died, their kids would get about $673,000, and Uncle Sam, and in this case, I think it was the state of Ohio, is going to get about $366,000. And what I say to clients right here is, because a lot of times they'll say, well, I don't really care. That's, I'm not here. And I'll say, well, let me ask you a question. How long did it take you to put together, and maybe me helping you, the $1 million and so we started with? And they'll tell you their story. They'll tell you how long it took them to build that and how many years they worked. And I'll say, if you've got the choice, would you not rather see that go to who you wanted it to go to, or do you want it to go to Uncle Sam? And they really sit up in their chair. It's very interesting to watch the changes in their body language. So then we go to the second one, and so this is your family strategy. You're going to take out more, we're going to ease, and you're going to pay less tax over time. And frankly, if something happens to one of you, remember going back to the single taxpayer bracket, you may not end up paying as much either. Because if one of you is still living, you still got your IRA, don't you? And you have to still take out that same required distribution. So if we do this and we start using some of this and buy this life insurance contract, your children are going to get 1.679 of after-tax dollars. The IRS, and in this case the state of Ohio, is going to get $221,000. How does that make you feel? And most of the time they'll say, that's very interesting. Can you explain to me more? And I'll say, sure, I'll be able to show you a way. And then finally, if you know that they're passionate about their charities, and you can find that on the tax return, go on your Schedule A and look under charitable contributions. And I believe this firmly. If you see no deductions, you are not going to get people to do this because they are not charitably inclined. But wouldn't you agree, John?
Absolutely. Good point.
But if there is any type of charitable contribution, normally church or that, they will listen to you. And then I ask them this question: Mr. and Mrs. Client, do you know your great-grandparents' names? I always get cold chills down when I ask this question. And they'll look at you like, what? Do you know your great-grandparents' names? And sometimes they do, sometimes they don't. And then I'll say, do you want your great-grandchildren to know your name? And what do you think they say, John?
Of course.
Of course. And I'll say, let me show you a way. And so, again, now what I've been doing, I've talked to John about this, we've got the life insurance, we're going to set up donor-advised funds and let those monies flow right in. They're going to be able to determine the endowments and what they want to do, and the clients are just loving it. But those are some ways that you can truly leverage tax dollars in the right brackets, grow for the clients their pots of money that they never thought they'd ever be able to do. And it's all because you're just adding an additional level of value that nobody else talks about this to them at all. Finally, then, let me very quickly finish the last two slides. I got this in the mail from I think it was Insurance Elite Club or Annuity Elite Club, I don't know, but it is an overlay. So you can get this again. You call your insurance internal wholesaler or your RVP, but it is the coolest thing. It is a plastic overlay that you can actually stick your client's tax return in. It's so cool. And it overlays and it gives you ideas about talking to the client. Thank you. John's got one in front of him. As far as reading their own individual tax return. A couple places that are critical for you as well. And I always say if I have their tax return, I can tell you everything about a client. So if I have a new prospect, I ask them always to bring their tax return. Sometimes they don't bring anything else but that. I can pretty much know exactly what they've got other than the exact amount of their 401k. And frankly, if I get their working papers and look at some of that, I can find it too. But this is great. Remember on a tax return, and this is a best practice because now's the time to get them. We have Jane call now. We know you're getting your taxes done. If you wouldn't mind, if you're in the area, could you bring the whole thing by? Because we want to make copies of what we want to do. You need to know the whole thing. You need their Schedule D. You need some of those 5498s from other firms. so that you can gather those assets and ACAT transfer them in. Their Schedule B is going to share with you all the places they have other money. I always laugh and say I had this guy back when interest rates were pretty good at the credit union, but he had all this interest on his Schedule B, and I calculated, how much it was. I said, I didn't know you had $500,000 at the credit union, and he said, how'd you know that? And I said, I know everything. But little by little, we moved it all over here because I knew where it was. The other big benefit, too, on your tax return is you can see Line 17 allows you to know if they have a small business, a subchapter S. They may have a trust. They may have rental property. So that helps you understand better all the other things that, I forgot to tell you about. Have you ever had them do that? That's very important to be able to see that. And then I think that last slide, we'll finish up going back again to what we began with, which are the tax brackets. You need to make sure 43 and 45, that's the taxable income. So that's what you need to know. What is that final number? Which marginal tax bracket did I end up in? And what's that next dollar that we've got some room to be able to utilize? So this was quick, John. I know a lot of information. There's jewels in all of this. Hopefully you'll find one or two things that very quickly you can start using right away. That would be my encouragement. At this time, you've got an opportunity to ask people to bring their tax returns, so get them to do that.
Yeah, I mean, people are your early filers are possibly getting them back now. Now that the corporate tax deadline of March 15th has passed, CPAs are digging into individual returns. So this is a way you can create significant value with clients. Now, Beth is obviously significantly versed in the tax code and knowing these. So is Drew. And not all of us are. Not all of us know as much about taxes. And I find a lot of advisors shy away from discussing it because they feel like they're not sure how they can create value. They don't know the tax code or the tax return as well. So Beth gave some really simple ways that you can create value for clients. So the first, filling up someone's marginal rate. At Ameriprise, the biggest bulk of clients tend to be in their 60s. The average age of a client of Ameriprise is pretty close to 60, and I see it time and time again that where client ages fall are in their 60s. So this is a tremendous opportunity to get those clients to take out of their IRA early. And you saw really by the I call it leveling, the RMD leveling by taking out early. That example where that client was going to be paying in the 90s, was $91,000 when they're 90 years old and in a very high tax bracket. By leveling out at 60, it never went above 60. And if you notice, at age 90, they had the exact same amount in their IRA. It was pretty close as far as the amount that was in there, but it reduced the taxes and it never got out of control. That's huge value, but the bigger value is what to do with that money. Do you put it somewhere where they'll never pay taxes again, like the policy that Beth's shown? And this also probably happens to be the highest GDC producing strategy, but it is also probably one of the biggest benefits that you can bring to clients to save them on taxes really throughout their life. And gosh, just showing them down the road how much taxes they can save their heirs, their kids, their grandkids, the people they really care about in their life is tremendous. And that's right. I'll pull it out again here. This RiverSource kind of 1040 overlay. If you're not sure how to read a tax return, it's real easy. It points out those areas on the return on the 1040. That you can at least find out what's going on, maybe find some opportunities. And Beth mentions a great way to find some more assets or find out what they really have at the bank. I think that's one of the biggest opportunities advisors have is a lot of money sitting around a bank that maybe you don't know about, maybe the client never said anything about, they got a CD that's kind of tucked away. That kind of stuff we can easily capture and do something better for them. But I like what Beth said. She knows everything because she learned how to read the tax return and to find information to go deeper with clients. So it's I would take the simple parts. If you're unsure where to start with taxes, take some of these simple strategies and go, and just continue to learn. This is a great way to create the biggest amount of value with clients. This is the kind of thing that will help you capture larger clients, your $1 million plus clients. This is where you can create a lot of value. And I really think something Drew talks about a lot, this is really how you can build a moat around these top clients and make sure that they never, ever leave. So, Drew, let's get some of your insights. What are your thoughts on with tax time coming, people getting their returns? I mean, what's your thoughts on some of these strategies? What are some things you're talking about with folks this time of year?
Well, Beth hit it out of the park. I think, I reiterate a lot of what she does. I think the biggest impact you can have with a client is, one, let them know about their Social Security being taxable, and let them know that their widow is going to be paying probably 40% more in taxes on the same amount of income than they would unless you make changes immediately. Grant's in here. He went with me on a death claim case just last week. Same thing's going to happen. So unless, for people that have incomes between, I would say, $40,000 to, $150 to $160, it's going to happen. So you need to be doing the planning up front. I do believe it's really high value, high impact that we can do. If you can't work your way around a tax return, challenge yourself to get better at doing that, because that's where the real money is helping people keep more of what they make.
Absolutely. So great concepts today. I think we got a lot of great stuff coming up here, a lot of great opportunities with clients. And, hey, a lot of great learning through Dynamic Directions. We got some more great webinars lined up. I think we got a case, Drew, that we can use in an upcoming webinar. We've got the Ritz-Carlton next week in New Orleans. We're looking forward to seeing you there, learning their excellence program. It's one of the best things I've been to. I've had the privilege of going through it twice. It's phenomenal. So we'll see you there next week. In about a month, we got the Ameriprise National Conference. Those that qualified out in Las Vegas. And then this summer, we've got the D2 Think Tank coming up in the number one conference city in America, Indianapolis, in July. So great stuff today. Thank you so much, Beth, for being on. We've had so many advisors have been begging Beth to show them this stuff. So it's great we captured it. We got it recorded. If you need to go back and review some of the things Beth said, some of the concepts, this will be recorded. The replay will probably go out here in the next day or two. So go back, listen to some of the stuff. But like Drew said, like Beth said, just challenge yourself. Pick one new area to use to discuss to help clients out in taxes. Probably one of the biggest values you can create for your best people, especially those with over $1 million, to bring people in and to keep people around. So Joyce had a great question here. Can we print off Beth's slides? Jacqueline, why don't we just include them in the follow-up email or just blast them out to everybody? We'll get those out to you, Joyce. I got a couple other messages, too. People are looking for the goods. So thank you all for being on today. We'll see you down in New Orleans next week. Get ready for a good time and stay bullish, and we'll see you next month. Take care.
Take care. Bye-bye.